When the economy sinks, most people freeze and hope for a miracle. The right move today can turn a recession into a ladder you keep climbing for years. Recessions don't just erase wealth, they expose habits that either drain your future or build it. I'm sharing a simple, repeatable plan I call the 3 buckets method. It focuses on safety, the core of investing, and small, deliberate bets when prices are depressed. This isn't a forecast or hype. It's a practical guide you can apply with numbers you already have. Bucket 1 is cash, runway, and resilience. It keeps you secure so you won't rush into bad deals. Bucket 2 holds your core investments. It's low-cost, broad, and designed to stay useful through every downturn. Bucket 3 is opportunistic bets. This is where you put a small, thoughtful portion of money into hand-picked opportunities. Step 1 is to build a cash runway large enough to cover essential spending for a period. 6 to 12 months is a sensible target, depending on your job security and the volatility you can tolerate. List your essential costs: housing, food, utilities, transport, health, then multiply by 6 to 12. If your essentials run about $2,500 a month, you're aiming for $15,000 to $30,000 in liquid savings. Keep that money in liquid places like a high-yield savings account or a short-term CD ladder. Accessibility matters more than a few extra basis points. Set up automatic transfers so this bucket grows without you needing to think about it. Treat it like a bill you must pay yourself first. Step 2 is debt discipline. In a recession, unpaid debt can steal your gains and ruin your capital plan. Write down every balance, interest rate, and minimum payment. Strategize by paying the highest rate debt first while keeping minimums on the rest. If you have a mortgage or student loans, check if you can refinance without expensive fees. Lower monthly payments can free up cash for your runway or investments. Avoid new consumer debt during a downturn. Use your cash runway to cover essential needs and avoid financing lifestyle choices. Step 3 is protect expenses and build good money habits. Small changes compound, especially when markets swing widely. Audit every subscription and negotiate bills where possible. Create a simple budget you can maintain even if work patterns shift. Ask yourself weekly, do I truly need this, and will it help me reach long-term goals? Step 4 is to hold a pocket of dry powder for opportunities. During big sell-offs, cash gives you the option to buy good companies at reasonable prices. This isn't gambling, it's disciplined capital that can move faster than a full cash round. Step 5 covers your core portfolio. Keep a low-cost mix of broad stock and bond funds that aligns with your time horizon. The goal is steady growth with risk controlled, not chasing the latest fad. Rebalance a few times a year to keep your target allocation. Letting emotions drive trades usually hurts long-term results. Step 6 introduces a few quality-oriented tilts. Look for companies with strong cash flow, durable brands, and robust balance sheets. In downturns, some businesses become cheaper but still perform well. Be selective and skip the high-risk bets even if they look tempting. Step 7 is adding bonds to balance risk. High-quality government and investment-grade corporate bonds can dampen volatility and provide income. TIPS or inflation-protected bonds can shield purchasing power if prices rise. Step 8 is dollar-cost averaging during downturns. If prices slide, automatic monthly buys keep you from guessing the bottom. Set up a fixed cadence and stick to it, even when the news is scary. Step 9 is tax efficiency. Use the right accounts for your situation, harvest losses when it makes sense, and minimize fees. Step 10 is a sturdy mental model. Recessions punish impatience and reward discipline, so keep a long horizon and avoid impulsive bets. Create a monthly ritual to review money, not just markets. Track cash, debt, spending, and alignment with your 3 buckets. If you see drift, adjust in small steps. Small, deliberate moves beat big, erratic ones. Common mistakes to avoid include chasing hot tips, panicking and selling lows, and ignoring costs. Never over-leverage or borrow to invest. Keep your runway intact and your core plan intact. Let me run a simple scenario to make this real. Imagine your essential costs are $3,000 a month, so a 6-month runway is about $18,000. When you save more, you allocate roughly half to the core portfolio, a quarter to opportunistic cash, and a quarter to safe bonds or inflation-protected options. If this makes sense, hit like, subscribe, and drop a comment with your plan or questions.